For those of us joining us live and the number of you joining us on the replay, thank you for sharing your time with us. My name is Jeff Hunter. I'm a portfolio manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line is our lead investment advisors, Dave Townshend and Raheem Somani. For more information about our group, please check out mywealthmanager.ca. Today's call is with award-winning portfolio manager Kevin Vandermeer and Meng Gao in Investment Advisory Solutions to discuss the markets and our global ETF portfolios. Before we get started, just a couple of housekeeping items. We have muted participants, but in the chat below, feel free to direct any questions to Dave, Raheem, or myself, and we'd be more than happy to ask on your behalf. Today's call will be recorded, so make sure to check your emails in the coming days for the replay information or follow our team's Facebook page at facebook.com/mywealthmanager.ca. With that said, let's get started. Kevin, pass it over to you.
Great. Well, thank you, ladies and gentlemen, for taking the time to join us. Very quickly today, we're going to look at really what I hope to do is really walk you through a number of global markets, look at a number of different indexes, asset classes, and kind of give you a view of what's going on around the world from an investment standpoint. And then we're going to talk about a few things like the U.S. election, what that might mean for the markets. And then we'll finish off with a product or solution that we think, positions you well, in the current times, and, is a conservative product that will help you benefit from many of the markets and trends that we're going to show you today. So if we start with the first slide, what you're looking at here is how a number of indexes have performed over the last year. And so obviously most of you on the line today would know that through much of March and February, markets came under huge pressure as a result of us kind of grappling, all of us grappling with, what is a pandemic, and really nobody that's managing money today has ever managed through a pandemic. Nobody that's an investment professional today has ever seen, GDP contract at 30 or 40%. And so just enormous uncertainty. And then, as you know, governments around the world stepped in, whether it was providing assistance to employees or to individuals, or to corporations to sort of stabilize it and improve. But what's probably not well known by most people is that coming out of this, the Chinese market is one of the strongest, and really second to that is the U.S. And it's quite amazing that these are obviously two global powerhouses, at odds with each other, but yet their markets have done very well. And you can see lowly Canada there, kind of grouped with the emerging markets, if you will, or international markets, and so has lagged. And so, really, the case we want to make here is it's important to be to think about investing outside of Canada. Many of us live and work in Canada. We own our homes in Canada, so we have a lot of exposure to Canadian assets already, but there's a whole world out there in terms of equities. And as you can see, in many cases, other markets around the world can provide not only diversification, but also can improve returns. So it's really the comment there I would make. Now we're going to just pick up on the U.S. market, and what this slide shows is really you divide an index into 10 sectors, and it should come as no surprise that the technology sector has been one of the strongest over the past year, and you can see, even eclipsing its previous high, really driven by kind of 4 or 5 stocks. Those being Amazon, as I'm sure all of us on the call here today have taken advantage of that and having things delivered to our home, but it's also Microsoft, it's Apple. I'm speaking to you on an Apple phone right now. It's Netflix. So it's a lot of it is stay at home. These are stocks that are benefiting from the stay-at-home trend or economy, as many talk about it. But also inside of tech is Zoom, and Zoom is what we're using right now. But anything that's facilitating productivity, enhancing our ability to shelter in place and benefit or change our spending habits. Most of the companies that benefit from that are technology companies. So you can see the run up there. Unfortunately, you can also see that energy has been challenged. Obviously, when manufacturing slows down, when we drive less, when we don't make things, whether that's in emerging markets or in developed markets, we just use less energy. And so you can see how challenged energy has been. So the takeaway here is, look, you want to be diversified. You can see even in the last couple of weeks, technology has really sold off hard, where other sectors have held in better. They actually have not performed as well, but they've held in better. Next slide. I think we've kind of touched on this, but it just shows you that the point of this slide really is just to highlight what a dramatic impact a couple of key stocks. We can see here Apple, Amazon, Microsoft, Nvidia, which is a chip maker, and Facebook have had the contribution, if you will, or the impact that just these stocks have had on the upside. So if you didn't own really these 4 or 5 stocks, you would be lagging the index, potentially by as much as 6%. And then you can see below, we're showing you the stocks that have had the most negative impact. And not surprising, Exxon, an energy producer, but also you can see 3 out of the 5 names are banks. And obviously, when an economy is challenged, people are wrestling with what those loan losses might be, and trying to decide, if this pandemic is going to last longer, or what kind of impact it would have. And so people have stepped away from the banks for the most part. And Boeing, obviously, a manufacturer of planes and selling into the airline industry, you would not be surprised that would be somewhat challenged. Again, just trying to show you the importance of diversification, but also showing the impact of just a couple of stocks. So now as we shift a little bit and look inside of Canada, and we look at the sectors that have performed well in Canada, you can see that the story is very much the same in Canada as in the US, and we shouldn't really necessarily be surprised by that. Obviously, our economies are highly intertwined, but you can see technology performing well. What would be different in Canada than in the US is materials. And this is primarily our materials sector right now is predominantly driven by gold. So a couple of large companies like Barrick, Franco-Nevada, Agnico Eagle, Kirkland Lake, Kinross. These are large global players in mining of gold. And gold, obviously, in an environment where you have inflation and 0 interest rates, gold, a lot of people are moving to gold. That will show you a slide in a minute, shows you how gold has performed. But as a safe haven, the price of gold has been driven up. And obviously, if you are somebody who is mining that, you obviously benefit from that. So the 2 strongest sectors in Canada have been technology and materials, but primarily the gold sector. And then healthcare and again, energy is challenged. I don't think I need to tell anybody on this call, how challenged the energy sector has been in Canada. But healthcare is really primarily cannabis, and that's an industry that probably got ahead of itself a little bit, but is going through sort of maturing and maturation there, and so the market is struggling a little bit with kind of the regulatory environment and the rollout and the execution and some of those larger businesses. we look at Canada, and again, just looking at those stocks that have had the biggest contribution, you can see Shopify, really an amazing story for Canada. It's actually one of the largest companies by market cap. It eclipsed Royal Bank, which is just an incredible feat in terms of its valuation and market cap, and is really driving the tech sector. But you can also see what follows below are three precious metals names, Silver Wheaton or Wheaton Precious Metals, as well as Franco. And then and quite surprising would be CN, which is benefiting obviously from the flow of goods across Canada, but it's really a very defensive industrial name in Canada. And then those companies that have hurt the index the most, very similar to the U.S. You see, energy names, Suncor, CNQ, Enbridge, and then again some bank stocks. Bank of Nova Scotia would be the most global of our Canadian banks, and Toronto Dominion would have the most exposure in the U.S. So those are the banks that have lagged the most among their sector and across the broader index. Go to the next slide. So now we're just going to shift. Now we've looked at equities and the importance of being diversified. We've looked at the sectors that have done well. We've looked at the component stocks that have really driven the performance in the index. And now we're going to shift to commodities. And you can see that both gold and silver, really silver and gold, silver is done really, really well here, and in gold to a less extent, but those have been the areas that you've wanted to be in. Again, natural gas and WTI have lagged primarily for commercial reasons, but gold another a safe haven, and silver to a lesser degree something that will hold its value. Now we're going to shift into fixed income, and we all have a fairly good understanding of where the yields are in the U.S. Treasuries. The U.S. Treasury is considered the most liquid security that's traded, like water. Really, it's the instrument that everybody goes to in the time of crisis, and you can see that one of the things you want to highlight here is that, in fact, U.S. Treasuries, the blue line here, actually traded up when every other chart I've shown you trades down. So you can see people flock to government securities. You can see that it's sort of flatlined, and then some of the other higher risk and what we call credit. So these are bonds that are either issued by corporations that would have higher risk, or even high yield that would have even higher risk to it. You can see that they were hit and have come back. The great thing about having credit as well as government securities in your portfolio is that obviously corporates would give you a higher yield, higher income. Same with high yield in a portfolio, and you can see here that corporates have actually outperformed government despite having been hit. But over a 1-year period, they've actually outperformed. And so, as we think about building, a pension-like portfolio, a diversified portfolio of not only equities but fixed income, even within fixed income, we want to talk to our clients about, having different types of fixed income exposure, so that you can actually generate a higher return than some of the low returns that you're getting in government bonds. We now shifting and sort of putting into context here, we all know we went down a long way back in March. The bottom was March 23rd. And then we all know that we've come back a long way from the bottom. And so we did a little bit of work on the Canadian markets and tried to put into context for our clients, this move off the bottom feels really strong, but how does it compare to some of the other bull markets? And what does that mean, after we've moved so much, where could it go? And so you can see that what we did here was we went back to 1977 and we looked at sort of 11 bull markets, if you will, or 11 corrections, and we laid them all on top of each other. And then what you can see is the current market that we're in, the current bull market that we're in right now, is that dark line. And you can see that it's been one of the strongest off the bottom. And the only two others that have been stronger have been 1982 and 2009. And really what's driving this is our governments and governments around the world are putting a lot of capital into the market. And that capital gets invested and pushes the market higher. So we can have a philosophical discussion about whether that's good or bad. But in the context of investing, we certainly expect that the trend to persist despite already moving higher and moving a lot. And despite that we're quite a ways up, we continue to believe that this market will continue to grind higher. We put this slide in because so much has been written about how expensive tech stocks are, how expensive the S&P 500 or the US market is, and that investors should seriously consider stepping away and thinking about investing in other markets. So, one of the challenges of the US market, it's definitely been one of the strongest, but one of the challenges has been it's also one of the most expensive. And so you can see here that over time, if you look at the black line, there's been times where developed markets ex-US, which would be the blue line, if we go back to like 85 and 88 and 1991, you can see that developed markets, and this would be Europe and Asia, anything ex emerging markets. So we think of emerging markets, think of China and Thailand and some of the South American countries. But developed markets ex US, you can see was at an extreme valuation, and then that valuation came down, and you can see right around 1999 when the tech boom took off, you saw that the US market really took the lead in terms of valuation. And then after 2000, you saw this collapse in valuations. And now we're starting to see that spread again between, call it developed markets, ex-US, and emerging markets. Now you can see in the chart, and the US market in general. And so we show this to clients to give them sort of pause and to consider, look, it's easy to go to the US market. It's exciting. It's being driven by tech. It's well positioned, but also we think there's probably a good reason to think about investing outside of the US because you get better value, you can diversify, and if these valuations start to come in a bit, you're spreading investments around where you have cheaper valuations and better valuations, you're going to have a better experience over time. So there's a lot that's been written about the U.S. election, and as people who study the markets, we like to think about what this could mean, and what obviously I think early on, many of us thought that Trump would win, and then this pandemic hit. It's pretty obvious that the U.S. has not handled the pandemic well. That would be probably an understatement. And now we have this option of Biden. And so I think the market's already sort of figured out that maybe Biden, if Biden were to get in, and he's leading in the polls right now, his lead is narrowing, but he's still leading. And depending on who you read and what you read, he's well positioned to win. And it's very unusual. It's very unusual to unseat a sitting president. But if there was ever an unusual year, it's probably 2020, the year that we're in right now. And, so markets tend to, believe it or not, like Democratic presidents. Many of us would have thought that, with a Republican, a Republican president who tends to be more business friendly, that markets would perform better. but in fact, that's not the case. And so as we think of the potential for a Biden win, that actually could, based on evidence and analyzing historical precedent, that could actually mean a more positive market. The one thing that is pretty clear is that whether whether Trump gets in or Biden gets in, their taxes are going to have to go up in the U.S. And it's really just a matter of how quickly taxes go up. Under Biden, we would expect taxes to go up faster, and under Trump, he's probably going to fight it and try to delay it as much as possible. But eventually, taxes are going to go up, and we're going to need to see the U.S. is going to need to start to do a better job in balancing their budget. So, this slide here just shows you that under Democratic presidents, whether it was Clinton or Obama, for the most part, had some of the best returns. You can see, Republicans as well. Ronald Reagan, widely considered, very business friendly, but in fact, under Barack and under Clinton, the markets actually did better than under him. Look to the next slide. So now I'm going to hand it over to my partner, Meng Gao. Meng works closely with me, and he's going to walk you through our investment product. Hopefully we've given you a view of kind of what's going on around the world and kind of update you on what's working and what's not working. And then, we take all that information. What do we do with that? Well, here's an investment product where we try to bring that all together and really give you an opportunity to put your money around the world in a very thoughtful and very careful way. So I'll hand it over to Meng.
Thanks, Kevin. Good afternoon, everybody. It's a pleasure to speak to you all today. As Kevin mentioned, I'm a senior associate. My name is Meng Gao, and I've worked with Kevin for a little over 2 years now. It's been a great 2 years, and obviously I'm not just saying that because my boss is on the line, but Kevin has provided a great overview of the global markets, distinct asset classes, and some of the topical themes atop of investors' minds currently. I'll now take the next couple of minutes to introduce to you the Canaccord Global ETF portfolios. So I would highly encourage you to reach out to Dave, Jeff, or Heem, your advisors after the call if you're interested for follow-up. But hopefully I could take the next couple minutes to give you a little bit more knowledge, and you can walk away with a little bit more something on the solution that's available to you. So I'll skip this slide for now. I'll go to page 15. So the Canaccord Global ETF portfolios. So they are essentially a suite of 6 portfolios, 6 mandates, that range in various equity and fixed income exposures. So the most conservative we have over here is 40% equity and 60% fixed income, ranging to the most aggressive over here for capital appreciation at 80% equity and 20% fixed income. So as you can see, these portfolios primarily and only buy ETFs, and we use ETFs to get the underlying target exposure that we want. And these ETFs hold essentially the same securities or ETFs, but just in varying weights depending on which sleeve you'll be looking at. How you should think about each portfolio, you can think of it in 5 components or 5 buckets. So for equities, you have Canadian equity, US equity, and international equity. And in fixed income, you have short and the long term of the curve. So the strategy that we use for this portfolio, we overlay a momentum and trend following piece, but ultimately how we get alpha is we look into each bucket and we try to find a sector or the relative area that's outperforming the broader part. So we'll zone in Canadian equity, for example. As you can see, most of the weight is in XIC, which is a high quality iShares Canadian equity index ETF, but we currently have a tilt 2% or 1% in gold and technology. So if you recall in the beginning when Kevin showed you the best performing sectors, off of the performance, gold and technology has definitely helped us, but just thinking about it fundamentally, as Kevin mentioned, it's really, really hard to argue not owning gold in an expected negative real rate environment, where Feds are basically printing endless money. And obviously technology is one of the sectors in space and business where it's very CapEx light. And while other companies are currently still thinking about how to protect their balance sheet, protect capital, you can argue technology is already thinking about growth. And we really saw that through a stress test through COVID, where obviously Kevin has already mentioned technology names have really been outperforming. So these two tilts have really benefited these portfolios. For US equity, we have a tilt in software. So obviously this, once again, reemphasizes what I just mentioned about technology, but even more so because it's specifically software. And then over in international equity, we currently have a tilt and about 2% in China. So if you recall in the beginning, China is actually the best performing region on a one-year basis, even above the S&P 500 US. And this morning, we saw that in China, retail sales actually accelerated for the first time. And for the past 8 months, industrial sales actually grew. So you can see China is well ahead of the curve, and you can even argue they're mostly already at pre-COVID levels. So this tilt has already and definitely benefited the portfolios as well. And lastly, for fixed income, we currently have a tilt and bet on high yield. So obviously, in an environment where rates have virtually, floored for X many of years, Feds have essentially come to the market and said they would do nothing to stop at supporting liquidity. And obviously with synchronized global recovery, high yield is a great place to get some yield. And obviously when we entered the positions, this current spread that high yield was trading at, they represented a very opportunistic time. So we had a tilt there. So now turn to the next page, page 16. So on this slide, we chose to highlight the balanced growth, which is I guess you could say the standard 60% equity, 40% fixed income portfolio, but we would have a breakout of every portfolio that was mentioned. So if we look at where each bucket stacks against the benchmark and what our positions are currently, you can see that in Canadian equity, we are, I guess, 1% underweight, but that's really just rounding. We are market weight Canadian equities. We are most overweight US equities, and we are a little bit overweight international equities. So once again, if you recall the first slide where it shows you the performance across these nations, we are very well coherent and in sync with that. And you can see for fixed income here, we are slightly underweight, and this is not necessarily, I would say, a call on or a view on fixed income. Is more so we view equities for this period of time will generate better returns for us. So we use that and allocate it towards equities. So flipping back to the very first slide, what does this all mean? Why should you care? What are the benefits of this portfolio? So as Kevin mentioned, this is really meant to be Canaccord's, flagship high quality product that you can, put your money in and, sleep well at night. So I'll go over some of the key benefits and topics. So obviously asset diversification. Instead of owning 5, 6, 7 separate mutual funds to get the different target exposures or the geography sectors that you like, this is meant to be a one-stop solution where you get involved in this portfolio and you have exposure to all the different asset classes that was mentioned. Now the next 2 points are quite interesting. So global equity. So Vanguard did a study and it showed that Canadian investors and Australian investors actually tend to have a very high home country bias. Now, what this means is that, while their equity markets don't take up much percentage of the total global markets, investors actually tend to overweight and tilt their portfolio to their home country. Now, this is not off of any reason of outperformance, but simply because, they live there. So obviously this portfolio would get you that global exposure and fixed income. So, with my time here at Canaccord, we found that, obviously investors tend to be underweight fixed income. You'll typically find that, depending on, obviously your risk profile and your goals, it varies, but you'll typically find, stacked against what the standard should be, I guess, you'll find that investors are typically underweight. So if you recall, even the most aggressive portfolio capital appreciation, we have a 20% allocation to fixed income. So you're getting that growth, but also the fixed income. And fees. So obviously, the average mutual fund charges around 230 basis points, whereas, this solution is much cheaper. And so the next point is interesting. So, these portfolios have a ability to go up 20% cash during market stress. Now, I'll give you a good example of what happened. So back in February and March, during the miss and the heat of the pullback, just to, protect capital and be very prudent. And, we decided to go more cash. And obviously on hindsight that, obviously caused a bit of underperformance for that period, but, we quickly readjusted and got back. So this line here, is not just to put it there, we really do think about going into cash when, expected volatility comes. And then the last point I'll mention here is transparency. So obviously, if you use a third-party provider, it's very hard to get access to the portfolio managers and to really hear their current views. That doesn't mean we're gonna hop on a Zoom call every day of the week, but we can very likely set up weekly or very frequent calls and touch points to get the latest views that we have. And I'll just end here with performance. So down here you see as of August 31st, we're just highlighting the balance growth. Once again, the most popular 60% equity, 40% fixed income. As you can see, month to date, we are up about 229 basis points. And year to date, we are around 400. Since inception, we have a healthy return of 7.5%. And yeah, we are well off to closing the year off with healthy returns. So I hope you learn a bit about these portfolios. And like I said, I would highly encourage you to reach out to Jeff, Dave, and Raheem directly. But I will turn the call over back to you, Kev, if you have anything to add.
That's great. Thank you, Meng. Yeah, so I mean, what's interesting about this portfolio, obviously global in nature, but you can see that right now, year to date, we would be outperforming Canada. And we're outperforming Canada like the pure index. We're outperforming with 40% bonds. So, I don't think there's any better way to say having diversification is a real benefit. And with a model like 60-40, where you have 60% equities, 40% fixed income, and having that model outperform the broad equity market in Canada, I think is really what we're trying to present here today to our clients. So back to you, Jeff, for questions. And I think we've kind of bottom of the hour here, but happy to take specific questions and try to answer people's concerns or address people's concerns.
One of the quick things that comes to mind is just talking about the sharp decline at the beginning of the year, and that most people are underweight fixed income. Just how much volatility and market outlook, especially in a panic, so to speak, plays on people's ability to meet their financial goals. I'm reading something, you might have a better idea of the amount of people that liquidated near the end of March, everything, regardless of asset class, and more to do with taking on too much risk and having too much fear of future and ultimately giving out on those months to come, and the cost that they give up just for not being invested in those markets and being able to participate in the recovery.
Yeah, no, it's a great question. So what I would say is most people think they can take more risk than they really can. So in the overarching principle that I try to communicate to clients and even to my friends is that you want to have a strategy, an investment strategy that will keep you in the market. And so we're all different. We're all wired differently. We all can absorb different levels of risk. But the best portfolio is the portfolio that enables you to stay invested. And you want to stay invested because ultimately you need this capital that you're saving for retirement. And if all that you do is put it in the bank or in a GIC, inflation will eat at it. So you need to take this capital and grow it prudently. And in this case, you can see in this wildly diversified portfolio, over 6 or 7 years that this product has been running, it did 7%. And I think that's kind of whether it's 5 or 6 or 7% the next 10 years. You want to be growing your capital, but you want to be growing it judiciously and in a structure that allows you to stay in the trade, if you will. So as a general rule, I coach clients to start with their age. And so, you know, I'm not 40, but I'm not 50. How's that? But I feel 30. How's that? So I would encourage people, if you know, if you're 40 years old, you should have at least 40% of your liquid net worth in fixed income. And many people will balk, and even my friends will balk at that. But I said, in the bottom of March 23rd, did you wish you had more equity exposure than you had? And most people say no. So that's where I would start, is take your age, put that in terms of fixed income. And then, you know, depending on your level of sophistication and your understanding of the markets, you can maybe reduce that by 5%. Or if you have no idea and you feel uncomfortable with the markets and you're 40 years old, then maybe you should have 45 or 50% of your money in fixed income, just so that you you feel comfortable with your investments. The other thing I encourage people to do and to think about is, if you're going about your work, you know, you're driving home, you're driving your kids to programs, you're watching TV, you're in a movie, and you're thinking about your portfolio and you're thinking, I think I have too much risk, then you probably have too much risk and you need to make that adjustment. Or if you're sitting there thinking, I'm not sure I have enough money in the market or I have enough exposure, then maybe you should reduce it. The ideal asset mix for any individual is the one that they don't think about. If you're going about your work and you're doing what you're doing and you're saving money, that's the place you want to find yourself. And it's okay if it changes over time, but that's what's going to enable you through market corrections to keep your money in, because the biggest risk is to pull your money out at the bottom and not ever feel comfortable enough to put that capital to work. So it's a very long response, Jeff, but I tried to give you a couple of things to think about in terms of your asset mix and how you come at fixed income, because it's such a highly bespoke, customized answer for each individual.
So just further on that, you have been overweight gold this entire year, and discussing how inflation eats away at just saving cash, which essentially is anything short term right now, with rates as low as they are. What brought you to that position? It is a different sector than most people are familiar with working, and how in the portfolio it's helped reduce volatility and actually add some gains in this current environment.
Yeah, no, it's a good question. So first of all, I've been managing money for more than 20 years. And I would not consider myself in any way a bull on gold, or a gold bug, as they describe themselves. You know, I worked for one of Canada's largest banks, ran a lot of money for them. There were a lot of people in that firm that understood gold far better than I did, understood mining. We had specialists. So I don't come at gold with a strong view. What I see is, you can see that the commodity is starting to work. It has been working for more than a year. And you're starting to see sort of this secular shift. And there's a lot of people that are my age or younger that have never had to own a gold stock, because they never worked. They weren't working. They weren't performing well. They were losing money. And all you have to do is pull up a chart of Barrick Gold, and really a lot of these gold stocks did nothing for 8 or 9 years. But now that gold is starting to work, and there's a lot of economies around the world that actually still have negative interest rates. If you're in an environment where you're basically at zero interest rates, and you have inflation eating at your savings, you basically have a sort of a negative carry. So what's happening is people are, and it's not just individual investors, it's large institutional clients, are allocating money to gold stocks or even to gold. And probably no better example than Berkshire Hathaway. Warren Buffett and his team, it wasn't necessarily him, but they did buy Barrick. And people will quickly point to the fact that Buffett bought gold. Actually, Buffett didn't buy gold. Buffett bought a gold stock. And the reason that they have a process and a discipline around that, and I think what they're really picking up on is that they think the price of gold is going to be strong or stable for a long period of time. And that if you're mining gold, the metrics around that, so you're going to generate strong free cash flow, you're going to have a strong balance sheet, finding new reserves is hard. So that's a good moat around that business. It takes a lot of capital to get into a mine and start mining it. So those are the types of things that not only gold bugs, but generalists in general, and even, world-class investors like Warren Buffett are contemplating and considering and actually allocating capital to. So when you come to the portfolio that we've constructed, you can see that we've put an allocation to gold, which is really gold miners around the world. And we think that they're going to benefit from those trends. It's not necessarily that we have a strong view on gold, but gold is one of the strongest commodities. And how do you benefit from that? You benefit by allocating a portion of the portfolio to gold stocks that'll benefit from a stronger commodity.
So you mentioned it's working. For a number of people who don't fully understand what that means, how does it's working and how does that fit into your investment process? What's behind discussing what's working and what's not working? Just using technology, I think that's been by and far the longest overweight position that you've had. How have you stuck with that? How have you kept with it throughout volatilities over these years? And when do you decide that it's not working? What factors?
Sure. No, it's a good question. So as part of our process, we use a multidisciplinary approach. We use fundamentals to analyze companies. We use quant screens, so we screen the broader market for attributes, and then we use a technical overlay. And many people are nervous or shy or concerned about technicals, but really, what technicals do is it's really just looking at price and price action. So, if you look at the number of charts that we showed you earlier, we showed you that the Chinese market and the U.S. market were markets that were working. What does that mean? They're strong, they're outperforming. So we tend in this portfolio, if we're going to tilt or allocate more capital to certain areas, we want to make sure that those are the strongest areas in the market. And our process has been back tested. We're using, people would call it momentum, other people would call it trend following. But really what we want to do is go to those parts of the market that are the strongest or that are working, and then spend our time drilling down and looking at what is it that's driving that, and are we comfortable with what are the fundamentals behind that. So to your question now, in terms of responding to your question about technology, really in Canada, what it was Shopify. So Shopify is a platform. It allows people to market their goods in a way that allows them to protect their brand and also face people on the internet. And so if you're a company that facilitates that, in many ways, the pandemic was a perfect storm for them. If you're a small store or if you're a mid-sized manufacturer or somebody that's selling a product, you may not have a website. You may not have an ability to market your product. And so Shopify was really well positioned for that. And just the sales, it consistently outperformed its analyst estimates, and the stock continued to run. Now, is the stock cheap? Absolutely not. It's really, really well positioned. But that's an example of how we get into a sector. We kind of drill down into a sector and make sure we're comfortable. We find a sector that's working, drill down and find the companies in that, make sure we're comfortable. And the same can be said of in the US market, where we had, you know, Microsoft was benefiting from people working at home, Apple, Amazon. So allocating a portion of that, of those portfolios to technology really benefited the portfolios.
Dave, Raheem, any further questions that you guys wanted to touch on or ask coming out of your way, or anyone below? We've got a couple more minutes to go if you want to top it in here. Otherwise, we can tie it off soon.
Kevin, just a question here. You know, we try to advocate our clients to become really excited about investing. You know, you're buying businesses, sectors, global markets on a daily basis. And generally over time, most financial institutions, government, banks are advocates of investing. So clients, as long as they have a good perspective and a good balance, should be able to navigate markets with good advisory teams and good solutions. What's getting you excited for the next year besides the election coming up? You know, I've always advocated to clients that volatility is a friend. It's a value creation opportunity. Warren Buffett does his best buying when there's global issues. The same with Prem Watsa and a number of the large investment gurus. So in your sphere, what's gotten you excited to create a lot of value over the next year?
Yeah, I guess it's a good question. I'd have to think about it a little bit more. I think near term, there's going to be volatility around the election. So I think people should prepare for that. And there's a couple of ways that we're starting to see people position. In the options market, people are positioning themselves for volatility to take advantage of that. So, you know, I think there's, we might not know the results of the election for quite some time, actually. And I don't think people fully appreciate that. If you have a lot of mail-in ballots, it may take some time to really, declare a winner, especially if it's tight. And how the market's going to deal with that, and that election may sit right inside of a second wave, and so you've just got a lot of uncertainty there, kind of in November and December. And, with Congress now basically saying that they're not going to push through, any more stimulus in front of the election, it's hard to imagine that they're going to necessarily bail out investors, November, December. So I think number one thing is just mentally prepare for some volatility. And when we say volatility, that's kind of code for markets dropping. Let's be very clear on that. So I think, if you, to the extent that you can have some cash and just kind of think through what you would do in a pullback and even write it down for yourself. I think longer term, there's two kind of macro things that I think a lot about. And one of them is this challenge between value and growth. So growth has outperformed value for kind of coming out of the credit crisis, if you will, and it's had this sort of long run. And so there's a lot of people that have declared value dead, but I think kind of old economies and kind of industrial companies and the banks and even, energy could have a bit of a renaissance here. So certainly think a lot about value, traditional value, and whether that comes back. And then the other thing is, and it really plays well into the conversation here, but the U.S. market has outperformed dramatically since the credit crisis. And if we could all take ourselves back in time to March of 2009, and we had to place bets on what we thought the strongest economy would be for the next 5 or 6 years, I'll bet you none of us would have bet the U.S. because the U.S. was ground zero for the housing issues. There was just there was this thing called, credit default swaps that nobody really understood. We just knew they were really bad. We had, AIG was going out of business. The car companies were trying to get bailed out. Everybody had way too much debt. Just was really hard to imagine that the U.S. market would be the winner coming out of that. And I think now we're in a situation where, people look at you and say, well, how could you invest in anything other than the U.S. market? Like it's performed so well. You have these enormously powerful and global software companies, and whether Amazon or Microsoft or Apple or Netflix or Google, whether these companies can continue to grow and whether the market supports those valuations going forward is yet to be determined. But there's still an incredible array of companies around the world, including in Europe, that are very good companies. And I think we've been dismissive of these companies for like 11 years. So I certainly think about, I'm not sure that the U.S. market is going to continue to outperform for the next 5 years or even 10 years. And I think a lot about international investing, a lot about emerging markets. China would be lumped in as the largest economy in emerging markets. And the first slide we showed you was that China was the strongest market globally. So those are kind of I would say the two or three things I think about. One is the election coming and the volatility that will be there, and then value versus growth, and then, U.S. versus the rest of the world and what that might look like. And I'm still very positive on technology. I think that it's an enabler and facilitator of productivity. Those business models are incredible at generating cash flow and enormous operating leverage. I'm just not sure that the market will continue to pay up for those businesses the way it has.
Thank you.
Perfect. I think with that in mind and everyone's time, just wanted to thank Kevin and Meng for joining us today. If you have any questions regarding the portfolios and markets, feel free to reach out to us. We're your resource. That's what gets us up every morning to be able to help you with your investments. So fire us an email, give us a call. We're more than happy to discuss. Thanks again, everyone. And with that, I'll wish everyone the best going forward and talk soon. Bye for now.
Great. Bye for now.